Hey Wade, real quick, could I sidetrack you just a little bit? We had a question from Rick as well as Terrell into the support that we were talking about that we would address on the webinar just so we'd have a little bit more time. Could I read you this real quick and maybe you could touch on it a little bit?
Yep, go for it.
It's regarding liquidity lines. So they both are asking actually pretty similar. It's funny that they came through at the same time. On last week's webinar, you were going through talking about how the market makers will induce traders to jump into the market by moving price in either direction, typically in what we would describe as a range. When lots of contraction is taking place, we get major and minor framework. So Rick's question was, as price is in a range and liquidity starts getting picked up by market makers or institutions to place their own trades, what actually moves the price inside of that level? And if you could just speak to the liquidity lines in general around there.
Sure. So, obviously, what moves price ultimately is supply and demand. If there is more supply, prices go down. If there's more demand, prices goes up. But ultimately, what moves price in reality is supply. So, who controls the supply is a question you need to ask. There was an awesome interview that I watched not too long ago. I'll have to find it. I think it's actually a pretty cool resource. I forget, but it was talking about, it was someone that was a market maker, not a big market maker, but they made a market in penny stocks, and he was talking about the games they played, and it was super interesting. In fact, Shane, remind me later to find that interview, because I think that'd be, even if we put a link to it in the course, it was a really good interview.
Noted.
So he asked the guy, these are flat stocks. Typically, they need promotion. They need energy drawn to the stock in the form of promotion, and they would hire a market maker, and they would literally gift the market maker stock so that they can start manipulating the price. And that's why the guy said, he's like, I was so spoiled because there's no liquidity. And remember, in order to buy and sell, you need people, willing buyers and sellers. So it's easy to just give stock away when it's not worth anything. But when you give stock away, they promote a bunch of news that brings liquidity, brings participants into the market that are willing to put their money up. But you have a market maker that's been gifted, in the case of a penny stock, they're gifted a stock so that they can start running the price, running control on it. And this market maker for these penny stocks was like, I used to build charts. So I would build charts and create patterns so that I knew the patterns, like the double bottoms and the head and shoulders and all that. I knew the prices to drive it to create a pattern that would induce demand. So anyway, it was really interesting. But to not to sidetrack, it really comes down. The question is, what moves price in these ranges, and it's really going to be the amount of supply that's in the market. And if all orders are routed through a market maker, meaning you're not going out and saying, I want to sell the market. I need to go out and I need to make some phone calls and find someone to buy. And it's happening off the exchange, right? Just buyer to buyer, or buyer to seller, seller to buyer. It's happening through the market maker. That's actually the value that the market maker provides, is that you don't have to think about it. You send it to the market maker, they handle it. But they have the ability not to find a buyer or seller to match you up with, and they just keep it in house. So the market maker can absorb a bunch of inventory. And if the market maker, them being, say, the shop owner, right? If you want to buy a box of Fruity Pebbles, right? And they're the only market in town, and everybody wants to buy Fruity Pebbles. And instead of having 100 boxes on the shelf, they leave 5 there and keep 100 in the back. Those Fruity Pebbles are going to sell for a premium. That's really ultimately what moves price, is going to be the supply. The demand, it's easy to create demand. You combine a positive news story with ticking up price. How do you tick up price? You cut supply. You just don't sell it, right? So demand's easy, but controlling supply, that's the key. That's the ticket. So going back to the story with the market maker in the penny stocks, he says that was really the key, was that they had all this free stock that they could use to flood the market, push the price down, or accumulate it back and cut supply and move the price up, which on the chart looks like price movement going up and down. Now, you guys don't know the nature of that price action. None of us really know who's doing that. And that can always happen when you got any player that's holding a substantial amount of the tradable daily volume, a typical tradable daily volume of inventory. They now have the power to do that, to cut supply. They just stop selling, or they, flood the market and cause the price to go down. If you have that power, now you can create patterns. You can create what the chart actually looks like. So all the other people that don't have the inventory to actually move price are now subject to only looking at the pattern on the chart. You guys with me, hopefully here. Hopefully I'm not losing you. So anyway, that's ultimately, to answer Rick's question, that's really what moves charts, is the cutting of supply and the controlling of supply. The demand is really just the product of the price movement in the news, but it's all really about who controls the supply. And when you get liquidity lines and you get these levels on our charts, that's the patterns and the point. That's the real patterns that matter. That's going to control the people that don't have the ultimate control. It's going to control their actions. But that's ultimately where the market makers and things are going to build up their own inventory, is understanding the real boundaries of the market, the real danger points, the blowout points, the stop taking levels. It's going to be market makers competing with each other in Forex when you have these really big markets. Obviously, I think there's going to be a lot of may never know for sure exactly how it goes down, but there have been fines and things that have come out. I think there's about 11 total banks that control over 50% of the volume in Forex. So I'm sure there's some coordination behind closed doors that happens between those banks to manipulate things. But ultimately, we're not going to know what the actual deal is. But the best we could do is just know where the outer boundaries of price need, where those are that are going to cause a flood of buying and selling. That is not going to be mostly the market makers. Market makers are not going to buy it and sell at stupid places, just simply because their demand that's coming to them doesn't even allow it. You have the regular traders that want to buy the breakouts, and their demand is coming in. The market makers need to already have the inventory to sell to them. So, same thing with the pump and dump schemes. They not only inherit the inventory, but they create demand. I don't care what positive news comes out. If there's a handful of traders that show up to a stock and it's flat for years, like nothing happening, what does everybody wait for? Everybody usually favors confirmation over trade placement. So they're going to wait for it to start pushing up, wait a little bit longer. So the market maker just needs to get enough people in the mix started so they could start moving price and buying and selling, trading with those people, so they can start building a chart, so that ultimately what's going to create the most demand is a nice uptick in price. And then boom, that's all you need. Demand comes in, market maker has the inventory to sell to them and start pumping the price. And then if it goes high enough, then you get floods of people. It starts hitting forums. Everything starts coming in from there, and then it kind of takes care of itself. And that's what they're saying. Those guys they're manipulating the penny stocks. They're like, it's so easy to make money because they got the stock for free in the first place. They're like, we didn't even really have to put up our money to accumulate it. So, that's a whole pretty crazy thing that happens there. Benefits of making markets and penny stocks, I guess. But and obviously there's some, I'm sure, some illegal things going on in that mix as well. But anyway, that's ultimately. I don't know if I took too long enough. That's kind of the answer to the question. Is really ultimately you want to know why markets move. You need to figure out who controls supply and how they do that. Cutting supply and flooding the market with supply. Demand takes care of itself with positive news and upticks in price.